making 12,500. 12,500 minus the 1,500.
So 11,000 is that?
11,000. Right?
I think so. Yeah. I don't have it in front of me, but that looks
Right.
right.
Should be it. So what is your NOL? Let's say that's it. NOL is 10,600. Right? Right?
Yes.
Okay, any questions with that one? Wait, no, wrong one. I know that. Again, correct answer is letter B. Depending on how you had the question set up, it would have been a different answer, but this is the same, equation. Because number four is again this particular question doesn't really. It's a good question because it's actually touching on several different concepts here, and it helps you understand what happened as part of the Tax Cuts and Jobs Act. What's the result of it? So here, let me just review the question. Read the question. Bill was a full-time accountant at a local CPA firm. According to the firm, he was terminated due to performance issues. However, some of the partners had made slanderous comments about Bill to clients that Bill previously worked on, which is defamation of character, right? Bill became aware of this and filed a lawsuit against the firm for defamation of character, and as a result, Bill was awarded $300,000. The attorney kept a third of the fee. So, what happens with this amount? This one for 2018. What do you guys think? What do you guys think with this one?
No, there's no tax. Yeah.
That's the case. Yeah, $300,000. All of it is even though he only received $200,000, you can't offset it. $300,000 is income. He'll get a 1099 for that. Attorney fees are no longer deductible. So again, if this question wasn't for 2017, the $100,000 would be a deduction from EGI as a miscellaneous expense deduction subject to the 2% floor, which that whole section is gone. So that's been eliminated. So think about that. This is where a lot of individuals are actually paying more in taxes as part of the Tax Cuts and Jobs Act, and not less in taxes. So
But
I
that's
guess
until 2025, right? It might change.
yeah, or yeah, until 2025, or if Congress decides to change it sooner. But yeah, it's scheduled to sunset, in 2025, and they usually just let it expire. So again, yeah, that's the case, unfortunately. And that goes for a lot of miscellaneous expense deduction, but this is a big one. Those attorney fees, which again, so we talk about injuries that result in taxable income, which is all non-physical injury, which this is one of them. And then we have physical injury with punitive damages. Same thing happens with the punitive damages. Punitive damages would be income, but any related attorney fees, no deduction. That gets tricky.
If the lawsuit was not for defamation and it was like for, say wrongful termination of like at his actual job, so it's kind of like an employment related suit, would there be any difference there?
Okay, it's still a non-physical recovery. You're suing somebody for non-physical injury, so it's the same result. Remember, the only thing that can be excluded is physical injury. And somebody injured you physically, and any kind of compensatory damages would be excluded from income. Punitive damages will be income. Anything other than that is considered income. So non-physical injury, which that would be a case, wrongful termination would be a case. Yeah, again, I can't see any code section that says otherwise. It's pretty clear. It's the only other issue with regarding like settlement. We talk about like wrongful convictions if they later been exonerated. That's not income, because if you think about it under tax law, the way it's there's no code section that would exclude that type of recovery, so it would be income. But it just doesn't seem fair in the justice system, so they just added that code section. But there's nothing there for other non-physical injury. That would just wrongful conviction is one of them that's excluded. Everything else is clear cut. Physical injury, the only thing that can be excluded is compensatory damages. Non-physical injury, everything is income. It's clear as that.
How is it divided if for a physical injury there is punitive damages?
That's income.
So the attorney fee, yeah, that's income. So the attorney fee, how is it split for the part for the compensatory and then
Well, you'll prorate it, but either that's a good point. How would you split the attorney fees? You'll prorate it, but does it even matter now? Considering you're not going to get any deduction anyway, does it even matter to prorate it? But yeah, you would prorate
well,
it.
if whatever goes on to the compensatory, that isn't included in gross income, so
Right.
it would like make sense to put as much attorney fee into that portion.
But hey, I think you're missing the point. Where do you deduct the attorney fees? What's the answer to the question that you see?
Well, you don't. Well, for the compensatory, for the physical, you don't include the award in.
Right, that amount. Yeah, that amount is
So
excluded.
whatever part of that is attorney fees
Right.
doesn't matter.
So the attorney fees, you're saying the attorney fees related to the punitive damages, yes. Well, actually, think about that for a second. The attorney fees related to the punitive damages, normally that would be a deduction, right?
Right. Oh, well, normally, but because normally the case is handled by
But
one
why?
attorney, one trial, right?
Okay, but why isn't there a deduction now? Nothing has changed. The answer is still the same. Again, let's just say the $300,000 was that included punitive damages from a physical injury. Same thing. Let's say they were awarded $200,000 for compensatory damages, $300 for punitive damage. The attorney kept a third. Doesn't matter what the amount is.
No,
What is
I
the
was just
answer?
wondering how it's split. If it's just so it's prorated. Attorney fee
Yeah,
is
you
prorated.
would split it, but the point is it doesn't matter because there's no deduction at all.
Right, because your taxable income, whether or not you assigned it to the portion that is punitive and the portion that is like physical or compensatory, it doesn't matter which one you assign it to because the income level is going to be the same. Because
I think
you're still not going to include the physical damages and income, and you're
but
still.
and the
No,
other side.
I might not be phrasing my question. What I'm trying. It's not important.
Well, it is important because the attorney fees are not deductible. You understand that part. Either way it goes, either way you
No, I understand. I don't think I expressed myself. I withdraw my question.
Okay, are you sure? We can come back to it.
Yes, yes.
We can come back to it later, like once you find better words to say it. But yeah, if it's a good question, we just need to find out what the question is. We'll come back to that later if you want to go over it later. Let's go to the next one. Number 5. This one's actually pretty interesting. So the alimony was again. This is pretty interesting. So the divorce became final in 2017. Let me say that again. In 2017, the divorce became final. So here are the additional facts. So the child, they have one child together, and the divorce decree provided $1,000 per month, of which $1,000 would be reduced to $600 when the niece reaches the age of 19. So how much is just by that language alone? If $1,000 is going to be the payment, it's going to be reduced to $600. $600 is it assumed that's going to be the continuous payment until Tammy either dies or remarries. That's the alimony, right? The $400 is considered child support. Again, if it's being reduced to $600, what is being reduced by the $400 represents child support. That's what one of the issues regarding that I was trying to test you on in this issue. Child support, not income to the recipient, right? Not a deduction for the person paying it. Alimony, on the other hand, because the divorce again was final in 2017, how was that treated? What do you guys think?
Well, 2017 is still you can it's a deduction, and she will put it as an income. However, the question is for 2018, so that was kind of confusing.
But it's not. I think you just answered it right there.
It all depends upon when the agreement was made, not when the
Exactly.
payment was made.
Exactly. It doesn't it doesn't matter when the payments were made. It all matters when the divorce was finalized. So you're
Oh,
right. It is. You're absolutely right about that. It's because of the date, it's considered alimony to the person receiving it, and a deduction for the person that's paying it. So the correct answer is letter B for this one. Again, again, that's just something that I guess people were divorce attorneys were playing with somewhat to the benefit of their clients. It's something to think about. Um, yeah, the thing about alimony, it gets tricky because there's still alimony. Don't assume that it's not income just because it's alimony and they're receiving it in 2020. It still can be income if the divorce was finalized in 2015, 2016. You know, as long as it's finalized, it's the old rules still apply. So that's
I had a question
and
about child support for head of house status. Child support would payments would count against the head of house for, say, Tammy. Like she would have to supply.
no,
No, it wouldn't.
not not necessarily.
No, okay.
That's
Because
just
like Tony's providing the child support, or is that
okay.
Tammy's contribution? That
No, Tony is providing child support. Okay, I guess that's a good question. Do you think Tony's contribution to the child support is enough to raise this child? Any child? The $400. Do you think that's enough to raise a child? Wouldn't it be reasonable to assume that Tammy's also contributing to the support of the child, right?
yes.
So it would be a factor. I guess you could include it as a worksheet, but but then that goes more not so much as the head of household filing status. Just think of in terms of whose dependent is it,
Right.
and not just the head of household filing status. Because as long as Denise is supporting her household and the household where the dependent lives, you can still get head of household. That's just a question regarding child support. Yeah, that's not something that would be against her. And even with the child support itself, that's not something that's directly related to the dependency test. If you think about it, because with the dependency under the child tax, under the qualifying child test, it's relationship, age test, self-support. As long as the dependent does not support himself or herself. So again, it all depends. Again, in some circumstances, the child support is sort of irrelevant. Under the qualifying child test, it is, or under the qualifying relative test, it's more relevant there because now you have the question is, does the taxpayer provide more than 50% support? So again, it all depends on what set of facts. But yeah, can I throw it off as a dependency? Perhaps, that's all facts and circumstances. But that's not what we were asking here. Right here, the question is just the alimony itself. Income to the person receiving it, deduction to the person, paying it. Alimony is a deduction for AGI. Number 6. So they have two properties. They primarily live in the residence in Illinois and occasionally live in Florida, probably in the winter. So David rents the property in Florida on occasion, and they use the property in Florida for 50 days. Oh no, they rented it for 50. They used the property for 50 days. They used his property in Florida for 50 days for personal use and rented it for 30 days. Okay, so that makes sense. So the personal days is 50 days, rental days is 30. Is 50 greater than 14? Yes.
yes,
Is 50 greater than 3? Yes, right? Yeah, I think so. What is it? What
yes.
do we have a
Vacation home.
vacation home. Next question. Question number 7. Which two require payment before petitioning? There's two.
District court and federal claims.
Yeah, that's district court and court of federal claims. Very good. All right, number 8. We're moving along. George is a licensed CPA practitioner who specializes in tax services. He believes that only individuals who are licensed CPA attorneys or enrolled agents should provide tax services. This is sort of based on what's sort of going on right now, sort of. An organization who shares his views is working on recommending legislation for unenrolled, unlicensed tax return preparers. George decided to assist the organization by paying the $10,000. What is the treatment of this payment?
Not deductible
Why is it not deductible?
because it's lobbying, no?
You guys agree with that? It is not deductible, but do you agree with the explanation? Yeah, I agree with this.
That's why I said it. Yeah.
It does sound like lobbying. Yeah, again, it doesn't clearly say what it is, but yeah, it's lobbying. Again, I guess the other part, I guess you can say it's political contribution. Nonetheless, it's still a non-deductible expense, either non-deductible because it's lobbying or non-deductible because it's a political contribution. In either case, you can't deduct it. But yeah, based on the way it's worded, it's any payment that's you're making a payment to an organization that's trying to influence legislation. That sounds like lobbying. Okay, number 9. So the next few questions are fun questions to ask. But I don't think I asked you all these questions. I think I only asked. I think I just asked you 9 and 10, if I'm not mistaken. I don't think I asked you to do all the way through. Yeah, I don't think so, because that would have involved more steps. Let's just do the whole thing then. So gross receipts. So we got net loss or net income, right? Net income is how much? 50,000, right? So that's step number 1, right? So we multiply that by times what, 92.35, right? And that's gonna give me my, oh crap, why did it do that? I would just bear with me. I don't know why I did that. Actually, hold on. All right, so what does that equal? 50,000 times 0.9235. So 46. Wait, sorry, 50,000 times 0.9235. Hold on. 46,175, right? And multiplied by 15.3%, right? And that equals SE tax, right? So that times, so that equals 7,000. That equals 7,065, right? That's just the SE tax. We got to figure out how much is deductible, right? So only 50% of it is deductible as an AGI deduction after we do the Schedule C. Come on, stop it. Hold on. So, all right, 3,532, right? That's the AGI deduction. Excuse the formatting mess. Okay, so we got net income, right? Net income is 50,000. And then we subtract deductions for AGI. So in this case, we already took out the business deduction, but we only have the 1/2. So 1/2 of SE tax, right? Which is that deduction I just gave you, minus 3,532, right? And that equals AGI, right? So AGI is 50,000 minus 3,432 equals 46,468, right? So it equals 46,468. Again, what we needed first is actually 46. Yeah, it's a rounding issue that I have here. Correct answer is 46,467, right? Yeah, it's a rounding error. Again, this would be 3, I guess. Um,
I also got 68, but I just
yeah,
did the one closest.
yeah, it was around. I don't. Yeah, that's. Sorry about that. That's. But did you guys figure out what again, rounding error there or rounding? Yeah, because if you think about it, you're supposed to round here at 7,065, and it's half of that. If you want to, that's how you're supposed to do it. If you want to do it, it's 7,065 is the SE tax, and half of that, rounding would be the 3533. That would be the closest way. But if you're doing it, yeah, step by step by step, you'll get 3432, and then you'll get the 46,467. But yeah, I guess yeah, it all depends on the rounding. But everybody, did you guys figure out this either way because of the rounding? It should have been close to it. Again, it's not 140 or $50,000. You got to take out the one half of the self-employment tax. Next step. This person is single, right? Single.
Can I just make a quick comment about that question?
Sure. Go ahead.
In my quiz, because you have the questions randomized, this was, for me, it was the first question, and it was phrased differently. It didn't say using the same facts as in a previous. It just said Sandra has 140,000 receipts and etc.
Well, it
So
had.
for some reason, and then the other question, the one that to determine the SE was further down. So to me, it didn't click that they were connected.
But yeah, it's not. It's the way it's worded is going to be the first one question would be this, and then determine the adjusted gross income. One question, and then it's going to another question. It could be this, and then determine the self-employment tax liability. It still walks you through the steps. Yeah, it's not. It's intentionally done that way, so it's not in order. But you're still walking through the same steps. So if you had it, right next to each other, it would work. It would save
It
you
would have
time.
clicked for me, but yeah. So
Yeah, and it would have.
I got that one wrong.
Yeah, yeah, that would have clicked and helped out a lot. But I wasn't trying to confuse anybody. Just trying to,
They should have been grouped together.
I don't know how to. I don't know how I can still group
Because
them.
even though it also used the word name Sandra, but when you're taking a quiz and this one is number question 1 and the other one is further down, you don't connect. I mean, at least maybe it didn't. I didn't connect the two questions together.
Well, even if you can't see that connection, but the concept is still the same. So let's say for this question, if I'm asking just for not the self-employment tax, what's the AGI? The AGI is not $50,000. This person is self-employed. The AGI is not $50,000. You should think, well, what deductions can we take for individuals that are self-employed? Okay, there's something that has to do with self-employment tax. Oh, that means I have to figure out self-employment tax. Oh, that's about it.
So there's
Again,
no other category to what she could have been. She has to be self-employed for these figures.
yes, she's
It
self-employed.
couldn't be a partnership or anything like that.
Well, partnership still applies. Even if it's a partnership, it's still subject to self-employment tax.
Okay.
What case would it not be? What case would a business not be subject to self-employment tax? I'll give you a hint. I sort of gave you this answer before, and this is not something that we cover in this class. But you're actually thinking along that line, not a partnership.
S corporations.
Corporations do not pay self-employment tax. So if that was the case, yeah, there's no self-employment tax liability. But how do they pay payroll taxes? They got the employee.
Dividends, right?
Well, no, not the dividend. Dividends are not subject to FICA taxes.
Right.
the employee slash shareholder would have to take out a salary. That's how they take out the FICA taxes. So either way it goes, there's still a portion of FICA taxes, but it's treated differently. But it's not self-employment tax in that case. But that's as corporations and partnerships. We haven't even covered that. In this class, we talked the business entities that we have talked about is only one, a sole proprietorship. Sole proprietorship has self-employment tax. Period. That's the way it goes. But speaking of which, I guess that's an important concept to think about. If in some cases is it beneficial to if for it to be a hobby instead of an actual for FICA taxes, yes. And then something else to think about, and this is a question that does come up with when it comes to real estate. Um, when is real estate considered a business, or when is real estate? A more better question is, when is real estate considered inventory? And then do they pay FICA taxes on that? Well, if it's inventory, it's ordinary income, and yes, they pay FICA taxes on that. So one of the things that people don't think about when it comes to real estate, generally speaking, there is no FICA taxes, depending on how they set it up. If they're in the business of quote unquote, or I guess quote flipping properties, as people say, their intention of that business is to buy property, fix them up, and sell them in the short term. What does that sound like to you? Does that sound like an investment? Does that sound like a fixed asset, or does that sound like inventory? For me, it seems pretty simple. What do you guys think? Again, I'll give you the explanation again. The intention for somebody that flips property, generally speaking, the intention is for that individual or that taxpayer to buy property, make improvements, and sell it short term. What does that sound like to you? Inventory, doesn't it? If the intent is to hold it short term and flip it, that's inventory. If you're selling inventory, that's subject to FICA taxes. That's subject to self-employment taxes. So you got to be careful when it comes to, especially even with dealing with real estate. Sometimes that does generate, FICA taxes. And don't get me started on the Airbnb. If it's more than the capacity of rental property, if it's an ongoing business, then that's subject to FICA taxes as well. Something to keep in mind. When it comes to rental property, I did mention that rental property for right now, it's either a vacation home or rental property under Section 469 passive activity. Yes, that's a basic classification. But what if this person's in the business of renting out, a unit, an apartment of their condo? If it's an ongoing business, then that part is considered a business. That's subject to FICA taxes. It's self-employment activity, not rental activity. So again, it all depends on the type of activity. Most of the times, rental activities is passive, and then it's the same rules as we covered. But it all depends on the level of activity. That part is more complicated than what we're going to cover in today's lesson. But let's move on with this one. So the modified taxable income. Remember, I told you with this one, as far as the qualified business deduction, QBID, it's something like lesser of, what do we got, 20% of QBI. QBI in this case, it's net income minus one half of self-employment tax, minus the SEP contribution, and minus the SEP contribution, and minus the health insurance premiums for self-employed individuals. The only thing we have here is it's just one half of self-employment tax. So that's it, which is the same thing as the AGI, or 20% of modified taxable income. Modified taxable income is AGI minus the standard deduction, or in this case, no, it is the standard deduction, no itemized deduction. So in this case, it's 34,268, right? Times 20%. That's the smaller number, right? Remember I told you that as a shortcut, that's usually going to be the smaller number. So that equals 6,854, right? So QBI deduction, 6,854. So taxable income, again, we got 46,467 minus 12,200 minus 6,854. that equals 27,413, right? Okay. Wait. Well, with this one, it's not there. What did I do wrong? I didn't do anything wrong. Let's see, 46,467 minus. Oh, I know what I did. Yeah, it's gonna be off by $200. I originally put this question. I had used a $12,000 instead of $12,200 as the standard deduction. Um, so nonetheless, the correct answer. So if you use the 2018 figures, this would have been the answer. If you use the 2018 figures, but in this case, uh, taxable income is 27,413. It's should update this one. Any questions? Let me bring it down so you guys can see the work and take a look at this. Again, this is going to be on the exam. Everything in terms of the self-employment activity, that's going to be the big problem that involves several steps. And that was it. Any questions on this? No questions? Okay, you guys good. So that means you guys are ready for this, I think. So let's talk about. So last session we started talking about tax. Actually, you know what I want to show you. Since we were talking about FICA taxes, and the questions did come up about self-employment tax, let's revisit that table that I showed you way back when. The one that has the different entities. Let me pull it up, and I want to go over it again. Because yeah, it is good to at least understand that when it comes to businesses, yeah, if it's a sole proprietorship, if it's an ongoing business, then yes, it's the FICA taxes. When it comes to partnerships, same rules apply for partnerships. If they materially participate, if they're a limited investor, a passive investor in a partnership, then generally speaking, no. If they're part of the business, part of the normal operations, materially participant, then that is subject to self-employment tax. But that's not true when it comes to S corporations. When it comes to S corporation, it's actually treated differently. Here's the business entity table. Yeah, I have this on hold on. This is on Brightspace. And let's just walk through it again. It's a good time to review it. Okay, can you guys see? Okay, again, the sole proprietorship is the first column. The first column in the sole proprietorship, there's no entity level tax, meaning the sole proprietorship itself does not pay any income tax. And as far as that goes, only the owner pays the income tax on the profits. And again, takeaway is that income is not just subject to income tax, as we just went over, it's also subject to self-employment tax, as we also went over. When the owner of the sole proprietor takes out a distribution, then that's considered tax-free because they're already paying income when they earn it. So generally, that's considered tax-free. So again, and as far as salary, you can't take a salary to the owner in the sole proprietorship. It just doesn't make any sense. Again, you're already paying FICA tax on net income, and it just doesn't make any sense. People have tried that on a sole proprietorship, and I just don't get it. They try to run themselves on payroll. I'm like, you're already paying FICA taxes when you're on your net income anyway. It baffles me. Somebody told them to do it that way, but in a sole proprietorship, it doesn't work. S corporations, C corporations, yes, it does work, but not even in a partnership. Partnership, it works differently. So let's go over the partnership. For a partnership, it's a flow-through entity. The partners pay income tax on their share of profits. The partners that, not only that, the partners that materially participate, that's subject to self-employment tax. This is the part that, again, somebody asked, a few minutes ago about what if it's a partnership? Well, if it's a partnership and that partner does materially participate, they're actively involved in the business, they meet one of the material participation rules, then they pay self-employment tax in addition to the income tax. But what if that partner receives not a draw, but a guaranteed payment, which is similar to a salary, but it doesn't. There's no. It doesn't. You don't get a W-2 that's reported separately on the K-1. That amount is subject to self-employment tax. That's different than a draw. Partners can actually get paid for services to the partnership in the form of a guaranteed payment. That is subject to self-employment tax. So not only are they paying self-employment tax on their share of income, also on the guaranteed payment. But the guaranteed payment is a deduction on the partnership return.
What
Just keep
qualifies
that
as
in.
a guaranteed payment? Is it? It's not about how you split profits. Is it
It can
more?
be. It could be how you split profits.
Or is it
The,
like
the thing about the guaranteed payment, it could be it's not necessarily the way they split profit in terms of I get 50%, 50%. It's usually more commission based. It could be commission based to give the partners an incentive. But again, it could be separate from just their interest on the partnership. They're gonna on the partnership agreement. I'm gonna get 50% of the profits, 50% of the losses, 50% of the capital. That's it, and the other partner gets 50% of that. But in addition, I'm gonna take out a guaranteed payment for any clients that I bring in. I'm gonna take 50% of those fees or 20% of those fees. That amount is separate from the 50% of my share of profits from the partnership. It could be, yeah, it could be worded that way. If it's, I guess, with the simplest way I can explain it, if it's in exchange for services, they're getting compensated for services. It's a guaranteed payment. So just look at it that way. And in terms of what can be guaranteed payment, yeah, it can be share of profits. It could even, and the other side of it is, and I don't want to tell you this may confuse you. Guaranteed payments for the most part is subject to self-employment tax because guaranteed payments are for services rendered. I'm going to perform a service and then I'm going to get payment. Either because I'm going to get X amount for the clients that I bring in plus a 50% of profits, or it's going to be some other way, and it's based on my services to the partnership. So that's a guaranteed payment. However, a guaranteed payment can also be different. A guaranteed payment can also be like an exchange for something other than not in services. Which, let's say I'm leasing property to the partnership, and the partnership is going to give me a payment, and that lease payment, which if you think about it, it's rent, is going to be paid to me. The rent itself is not subject to self-employment tax. That what I'm describing right there, the type of range that I just described, that's more of a guaranteed payment that's not subject to self-employment tax. That's the best way that I can explain it now, but it's not as simple as that at all. Guaranteed payments for the most part is subject to self-employment tax. Rare situations is it not. It all depends on the type of transactions, and that again, you got to be very very careful with that. For the most part, if it's exchange for services, subject to self-employment tax. If they take out a draw, that draw itself is not subject to self-employment tax because that's a return of capital. They're already paying taxes on their income here. When they take it out, it's tax-free return of capital. That's the general rule. It gets a bit more complicated than that. So generally, it's considered tax-free. S corporations work a little bit differently. For an S corporation, it is a flow-through entity. There is no entity level tax. Again, the owners pay tax on their share of profits.
I
There's
have a question.
Well, hold on. Let me finish this discussion.
Okay.
There's no self-employment tax. There's no self-employment tax. But then again, how do the IRS get their share of FICA taxes? Payroll. Shareholders that are also employees that perform services to the corporation are employees. They should be taking out a salary. So any individual that performs services to the corporation has to take out a salary. That amount is subject to FICA tax, and they got to run it through payroll. Now, regarding distributions, distributions are generally tax-free. Now, just a little bit about C corporations, just quick overview. C corporations, two level of taxes, entity level tax, and when the owner receives a dividend, that's subject to I mean, not self-employment tax, that's subject to income tax. No self-employment tax on a corporation. Let me repeat that. No self-employment tax on any type of corporation at all. Instead, a shareholder that performs services to the corporation has to take out a salary. And in terms of the dividends, how are dividends treated? Well, double taxation. Now, I want to just make another comment about the salaries that regarding S corporations and employees itself. Now, when you think of a sole proprietorship, the sole proprietorship, that's the owner. So the owner's performing services, right? And the owner shouldn't take out a salary because it doesn't make any sense. So the owner takes out a draw, and that's a return of capital because he's already paying taxes on his share of income or her share of income. Same thing happens with a partnership, right? With a partnership, it's the same thing. Partner doesn't have to take out a guaranteed payment because they're already paying taxes on their share of income, and if they materially participate, they're also paying FICA taxes. So the owners in a sole proprietorship perform services, and they're already getting compensated, and they're already paying FICA taxes. In a partnership, if they're taking the guaranteed payment or not, they're still paying FICA taxes. Now, let's just think about a corporation itself. Does the corporation itself or the entity itself can the entity run without labor? What do you guys think? No, I guess it goes back to the sole proprietorship and partnership. Can the sole proprietorship exist without the owner? No, no.
No.
Can a partnership exist without the partners? The partners have to perform services. The owner has to perform services. Can a corporation exist, generally speaking? Can a corporation exist without labor, without any employees, without any wages? I guess it is possible, but generally speaking, the way you understand the way businesses operate, can a corporation exist without payroll? Probably not, right? So that's one of the first things that they're going to look at. Well, if they don't have any payroll, maybe the owner is they're barely making any ends meet. They're breaking even, so they're not going to raise the question. But if the S corporation is generating a profit and the owner is taking out a draw, eventually the owner is going to say, or the IRS is going to say, well, wait a minute, some of that is considered compensation for your services. In essence, the corporation cannot exist unless there's some kind of labor, either independent laborers, you're paying somebody else to do the work, or you're doing the work. The entity itself cannot really exist without, somebody actually doing the work. Same thing for a sole proprietorship or for a partnership. Again, limited liability companies can be either type of entity. All right, now I'm open for questions on this. Go ahead with your question.
I have a question. So you know how S corporations, they are flow through entity, but that's for federal taxes, right? They still pay state taxes, right? Like 1%.
Um, this is a federal income tax class, so we're only.
I know, but just like just to make it clear, right? Like it depends the states. Some states
Well,
like Florida, they don't pay state
well,
tax.
there's 7 states that don't have an income tax, but that doesn't mean that they're automatically not going to have a tax on businesses. There may still be some business tax side of it. Now, in terms of Illinois, it's always going to be a flow through entity on the federal level and the state level. That's always going to be the case. Again, that's always going to be the case. Let me repeat that. On the federal level, it's always going to flow through. On the state level, it's still going to flow through. However, some states do charge not an income tax. Well, I guess it is like an income tax. In Illinois, we call it, well, it's an income tax slash replacement tax in Illinois, where there is a portion of income tax that the entity itself pays. Yeah, some states do have that, but it's still a flow through entity. The entity still flow through. So your share of profits will still be reported on your federal return and still be reported on your state return. That's always going to be true. But you're right. In some states, they do have a separate income tax, even though it's a flow-through entity. So on the federal level, it's a flow-through entity, but on the state level, they can actually charge either a replacement tax or some sort of an income tax. Now, you made a percentage as an example, that could be an example of percentage, but it's a case by case. It's not us. Some states do have it, some states don't. You got to do your research. You got to look at the state, either the State Department of Revenue, whatever their tax authority agency is in that state, and just see how, just do your research, see how they tax business entities, because you don't want to get your clients in trouble. And even taking it a step further, here's even like California is weird. They have all these types of taxes in California. And California, even though you know how we talked about disregarded entities, and then you can form an LLC, and then the entity you pay franchise tax. Most states have these annual franchise tax, separate from income, not based on income, just an annual fee that you pay. In California, they have this other tax that if anybody who files a Schedule C on their federal return has to file another tax because you have a business. It's I forgot what they called it. And it's in the I had to take care of this a couple of times with a couple of clients. And even if they just get paid like a 1099, if you get paid a 1099 as an independent contractor, you don't, in essence, you don't really have a business, but you do have a business for tax purposes. So for tax purposes, some states would say, well, you automatically have a business. You got to register with us now. Now you got to pay a fee, and that's like another, kind of worms right there that you got to deal with. Yeah, make sure you do your research, and just make sure you do it correctly. And another thing I want to mention too, because I know you're going to hear about this, what's the best state to get incorporated? Um, and I'm sure some of you may already know this. Everybody talks about Delaware. Well, that's not the best state to get incorporated. That's the state that has the lowest franchise tax. That's the best that I can say. However, most states would require you, like Illinois, would require you to register, even though you're incorporated somewhere else, but you're doing business in Illinois, you still got to register in Illinois, and you got to pay the taxes in Illinois. So even though you get incorporated, that doesn't really, you know, I guess lessen the burden of not paying, any taxes. You still have to pay some kind of taxes where you're doing business. It may help you with some taxes, but it doesn't make them go away. So forming an LLC or corporation in Delaware does not really save you money on taxes. Just forget what you heard when people start telling you on that. Because generally, for federal tax purposes, it's the same. But for state tax purposes, you still got to register in the state that you're doing business in, and in some cases, you would have to pay an annual fee. So it's almost the same thing. Any other questions on the different type of entities? Somebody else had a question, I think, on payroll. I think.
Can I ask one last question?
No.
I'm sorry.
Somebody had another question. I forgot who had that question when I was going over the S corp. Was that you? I thought it was somebody else. Didn't somebody else have a question on the payroll side when I was going over employees? No? Or did I answer the question already? All right, go ahead with your question. I guess you may ask me a question. Anybody?
I had a question on the LLC.
What about it?
So, why I understand the concept of LLC, like let's say a sole proprietorship, it will protect your assets, right? In case, like, let's see, someone sues you. But why will someone decide for an S corp to be an LLC if you are already protected from that?
You know what you should do? You should sign up for my corporate and entity tax class, and
Will that be on the fall?
yeah, that's in the fall.
Okay,
I
thanks.
mean, well, it's the best that I can tell you. Look at the table. That's the best that I can tell you. It all depends. And a huge part of it is, remember, the LLC is still going to pay FICA taxes, self-employment taxes, if it's a disregarded entity. But if it's an S corporation, you can still at least play with the salary. I shouldn't say that, but it does give an opportunity for, as long as the compensation is reasonable. I hate to use the word manipulate, but you can be creative. I can't. I hate using that word. I guess you could use be. You are manipulating.
Finesse.
Finesse. Thank you. Well, you know what I'm trying to get. You can, use your best judgment to for the salary, as long as it's reasonable, because that does get tested. As long as you can support it, by some, whatever your basis is, as long as you can support it, then as long as it's reasonable, you can finesse, and whatever, and you're paying your FICA taxes that way. Again, there's different ways that people do it. Some people just go, well, if I was working full time, this is how much I'll get paid, with the experience, and they go based on that. Or they'll just say, well, I'm the CFO of this company. CFO, at a similar company would get paid X. They go based on that. Some people even go as high as, I'm just going to max it out to the whatever the ceiling amount for Social Security taxes. That's actually a good number to use, because chances are, if you're at the whatever the Social Security max is, you're at whatever $120,000, and that's going to be your compensation. Next year, you're going to increase it to whatever the new ceiling is. You're already maxing out on your Social Security taxes. What you're not maxing out is your Medicare taxes. Well, is the IRS really going to challenge you there? The Medicare tax is only like 1.45%. No, you're already paying most of it anyway, so they're not going to challenge you on the 1.45%. Unlikely. If you use the Social Security as a base, that's a very reasonable base to use. A lot of people use that as a base because it's, again, not that you're not going to get audited. The likelihood of the IRS auditing you on the FICA taxes is very low, because on that basis they're already getting their Social Security taxes, and are they really going to go after the 1.45% of Medicare taxes? Unlikely. So not that it won't get audited, it might get audited, but the chances are slim. And some people even use this as a basis. They go based on whatever the amount is that's subject to for FUTA taxes or SUTA taxes, which is a lower amount, and I don't agree with that, because that amount, it's only like $10,000 or so that's subject to state unemployment taxes, and that amount, in my opinion, would be too low. So again, use your best judgment, and you'll come up with a good answer. Um, let's move on with regarding entities. But again, as far as that entities, we're covering that in more detail in the next class. What I do want you to go over, this entity is a sole proprietorship. Individuals is what we're going to talk about. So we talked about passive activities, and that's what we're going to talk about right now. Going back on passive activities. Do you guys take a look at my article? You guys read it? See, if I would give you extra credit, you guys would not do the work. Why would I give you extra credit? And I tell you guys to look at my YouTube page, and I don't see that many new subscribers. I tell you guys to read my articles, and you guys don't read my articles, so I'm not giving you extra credit. All right, let's go over the passive activity losses rules again. Now, again, this is just an overview, and then there's an example. I just created a new problem on Brightspace. What I did, I added the additional problem to the classroom problems for tax deduction, and it relates to passive activity losses and these two sections. Remember section 465, that pertains to how much have you stand to lose. To the extent that you materially participate, that's the limitation on your loss. Whatever you have stand to lose. That's the first hurdle. Now, this whole computation here, this particular equation, that's what we're going to cover in more detail in the next class, the corporate and entity tax class. That's this gets into a lot more detail, and even this part, the additional adjustment. But right now, all I want you to know is whatever they have stand to lose. That's just the basis. I'm going to refer to it as the basis. That's the maximum amount they can deduct. And then the next question is, well, do they have enough? Do they materially participate? Meaning, can they deduct it? If they materially participate, yes, it's limited to whatever they stand to lose. If they do not materially participate, then what are the rules? Net passive losses are not allowed. Passive losses can only offset passive income. And then any disallowed losses are carried forward. The only times you can use this is when you sell it or you're disposed. Now, here's when we talk about, what is considered material participation. Uh, what I want you to know is significant involvement. If you're the owner, your participation is significant. You meet one of the tests if you're the owner. So in a sole proprietorship, you do materially participate. In a partnership, it depends on your level of participation. But if you're the owner of a sole proprietorship, you do materially participate. Make sure you check that box on the Schedule C. All right, let's go over this question that I just created on Brightspace. So this is again pretty straightforward. This is actually testing on a couple of different questions or different topics. So Mia is single with no dependents, has the following information of income. Anything that sticks out that's not considered income, this is not considered income, right? So I'm going to cross that out. So that's not considered income, right? I remember something about what about interest on U.S. bonds? That's income, right? Interest on state refund, that is income. So for the top portion, and again, just a review of something you should already know. Second portion, this is where you need to understand what's going on. So Mia has interest in two different partnerships, and it should be she that she does not materially participate. So that makes it passive. Her share of a loss from partnership A was $30,000, and basis was $35,000. So on the at-risk rules, that loss is limited to the amount that she stands to lose. So that hurdle is met. However, she did not materially participate. She could only deduct the loss against any passive income. Let's see if there's any passive income in the next category. So again, $30,000, she may be able to deduct the full $30,000, but she could only deduct it offset it against passive income. So let's go over the next information. Her income from partnership B was $20,000 and basis is $25,000. The basis is not, it's sort of irrelevant here. So it's $20,000 of income. She did not materially participate. And itemized deduction is 15,500 and 12,200. So I'm only asking for adjusted gross income. Why did I give you that information? I think I was just trying to trick you here. So we got salary, right? Salary 250,000. U.S. bond interest 25,000. Interest on state refund 1,000. Net PAL 0. But wait a minute. So here's a note. Note. I'll put it on the bottom. So the AGI in this case, AGI in this case is going to be, just add those two numbers or all those numbers up. So 250,000 plus 25,000 plus 1,000, 276,000. Do you guys understand what we did here? Why did we not deduct it? Okay, so here's the explanation. Of course, if I was asking for taxable income, you'll take it a step further, but I'm not in this case. So in this case, no, because Mia did not materially participate, she cannot deduct net PAL, or net passive activity losses. She can only offset passive income or passive losses with passive income. As a result, how much is carried over? $10,000 is carried forward until it can be used. Remember, remember rules for PALs? What are the rules for PALs? So let's sort of do a bullet point. Again, bullet point. That's not what I wanted to do. There we go. No PALs allowed. So no losses, right? Only offset passive losses with passive income, right? Disallowed amount is carried forward. Remember when it can be used when they sell it or they die. All right, so any question with this part? Okay, so letter B. Let's just change the facts a little. Let's say letter B. Assume the same facts except Mia did materially participate. Wait, wrong one. So same set of facts except Mia did materially participate. So in this case, it's not passive anymore, right? It is considered material participation. So it's not a passive loss. So we have a net loss, right? We actually have two activities, right? So we have in this case, it's like you have to think of it this way. What letter B is asking is more like these are business activities that Mia's involved in. She's materially involved in. So it's like she has two businesses, right? So I guess one way of putting it, you don't have to offset passive income and passive losses. She can deduct the loss from partnership A, right? Because she has $35,000 in basis. She can deduct the full $30,000. So P ship A, she can deduct the $30,000, right? And then partnership partnership B in this case is income of $20,000, right? So in this case, what's going to be the AGI? If you add up all those numbers, what do we have here? 266? You guys see the difference between the two? One is a passive activity. You only offset passive losses against passive income. No net passive losses are allowed. Second one, it is material participation. You have a business, in essence. You can deduct the full loss to the extent that you have enough basis to cover it. Which in this case, $35,000 in basis, you have enough basis to cover it. Any questions with this part? You guys get the difference between the two? Does it make sense? All right, so the next step I want to ask you, and this is more like an advanced, something we're going to cover in more detail, next session, or I should say next entity class, the next class, the corporate entity class. So remember the basis. You start out with the initial basis. You add any share of income, subtract share of losses, and then any dividends and so forth. So think about this case. So after the $30,000 loss for partnership A, what is the basis now for next year? What do you guys think? So we started with $35,000. However, you absorbed $30,000 of that loss. What's the new basis for the next year? $5,000. Simple question, right? Remember, loss would decrease your basis, profits would increase your basis. So let's go over this example. What about partnership B? If she started out with 25,000 and she has income of 20,000, what is the basis next year of this partnership? 55,000, right? Again, you started out with 25,000. It's increased by your share of profits of $20,000. You have $55,000 now. Again, that computation, we'll cover that in more detail later, but it's just understanding what's going on in terms of your share of profits. Share of profits would increase your basis. Your share of losses would decrease your basis. Again, this is the new problem that I added on Brightspace. So here's the answer. Take a picture or screenshot it or something. No questions at all? I don't know what to think about it. You guys have no questions. So let's do the book. So we went over depreciation. Actually, we're still gonna do some problems here. Yeah, let's go over some of these. I want to give you some homework. Like, well, this is already your homework, but what I want to do next, I sort of want to get started with property transactions, just to give you enough, to read over the weekend. But I want to give you some problems from these chapters. Actually, we could do this. Let's We're done with chapter 6, but we're not done with chapter 7. Let's go over the net operating loss questions from chapter 7. There's actually a few of them from chapter 7. Tax depreciation, maybe we'll go over those. But I want to see how far we get into these NOL problems, and then I'll show you the property transaction problems. Okay, so give me a second. All right, where is it? This has quite a few problems on the casualty theft losses. That's not what I want you to see. Hold on. Hold on. I'm trying to show you the book. Oh, there it is. There it is. But here it is. Okay. Here we go. We got 43, 44. I guess we could do all of them, but it's going to be 43, 44. We'll do the first two, 43 and 44. I'll show you what the answer is, but the book slightly presents it a bit different. It's the same equation. They're presenting it a bit differently. Same equation, same steps. I want you to think about the same steps. So let's do 43 real quick in chapter 7. So again, was one of the ones that I did assign to you. So it's something that we could go over. So we got business receipts of 144,000 minus 180,000. Remember, there's a loss. There is no self-employment tax. If it was income, it's self-employment tax. So we have a net loss of $36,000, right? So that's the net loss, 144 minus 180. Then we have a net capital gain of 22,000, right? Then interest income of 3,000. So we have AGI of negative 1,000. We're either going to subtract from the itemized deduction or the standard deduction. Standard deduction for Mary filing jointly for 2019 was 24,400. I think. I'm pretty sure. Itemized deduction is 24,000. What should we take? What do you guys think? Standard deduction, right? We're taking a standard deduction. So I'm getting negative taxable income of 34,400. But let me show you what the answer has, because then we have to add back. Oh, by the way, non-business income, non-business deduction, we have standard deduction. Non-business income, we have these two items, right? So just keep that in mind. So let's go over the answer. So this was question 43. Here we go, 43. Again, we've 24,000. Why are they using 24,000?
Because he's single.
Oh, duh. I knew that. No, I didn't know that. I misread that. So my bad. Standard deduction is 12,200, which is greater than standard deduction. All right, so then we walked through it. AGI was 11,000. That's walked. It's just the difference was that the taxable income. But here's where we add back. Here's the tricky part. Remember I told you this is one of the things that happens as a, one of those unique things that happen. Remember, the idea is to add back non-business deductions, but it's non-business deduction in excess of non-business income. So non-business deductions was 24,000, right? But what was non-business income? 22,000 and 3,000, right? Non-business income was more, so we don't add anything back in that case. Again, it's the excess of non-business deductions over non-business income. If your non-business income is more, then you don't add anything back. Your taxable income is the same as your NOL, $35,000. I want to bring your attention now. Now, this part was not necessary. Deduction for qualified business income, it's zero. Remember, you don't get deduction on qualified business income because there is no income. It's a loss. Mario has no qualified business income in 2019. His business generated a loss, $36,000, and this loss will carry forward to future years and will reduce any qualified business income in those years. So it does have that negative effect to it going forward in terms of the losses. All right, so any questions on 43? Yeah, pretty straightforward. This is the concept that was, a bit different than the way we've been doing it. It's because non-business income was more than non-business deductions. You don't add anything. No questions on that one? All right, let's do the next one, 44. 44, we'll walk through this as well. So same thing we're going to do with this information. And they're even giving us information for 2019. Actually, this is a better question because it's taking you all the way down to 2020, keeping by the way, keep in mind regarding this especially this problem, this was before CARES Act. So just keep in mind that because it was before CARES Act, it's gonna change your answer, depending on how. Well, the answer is going to be how much you apply to the next year. All right, so we have net loss. We got a 276 minus 320. We're going to figure that out. Capital gains, we supposed to net the two. Itemized deduction, $18,000. They're filing a joint return. The standard deduction should be more than the itemized deduction. I'm going to take the standard deduction. Ordinary non-business income. It doesn't tell me what that is. Salary. Keep that in mind. That's business income, right? When we're doing the NOL computation at the end. So here's 2020 information. We're going to ignore that for right now. Deductions for 2019, 35,000, 400. Again, standard deduction is 24,400. All right, so let's go over the answer real quick. Again, they're doing it, the same as we're doing it. We've been doing it. Hold on, it's not showing up. Oh, there it is. There it is. Again, same steps. Figure out the net loss first, which is $44,000, and then you do the AGI. You add salary, non-business ordinary income, capital gains, and then the adjusted gross income is $15,000. So it's either going to be the standard deduction, right, or itemized deduction in this case. So what are we going to take in this case? Mary filing jointly, I've said 24,400. Standard deduction is higher, right? Again, same thing on the deduction on qualified business income. That's always going to be zero on a loss, so you get no deduction. Now, in terms of what's non-business income in this case, remember 24,400 non-business deduction. That's your itemized deduction, right? Non-business deduction. Now, what they did, they netted the two which is the correct way of doing the net capital gains with net capital losses. You have a net short-term capital gain of $11,000. The $11,000, that's income. That's non-business income, right? That's portfolio income. right? And then we also have non-ordinary income, $8,000. The $8,000 and $11,000, that's non-business income. So $24,000 minus the $19,000, the excess 5,400 gets added back. Notice that they left business salary alone. Remember how I told you salary goes with that category of active income? When it comes to figuring out the net operating loss computation, this step, that's business income or active income. So you're only adding non-business deductions and not in excess of non-business income. So we leave salary alone. Now, I just want to show you the answer to letter B. Well, here again, take a screenshot of this real quick so you guys can see. Take a couple minutes. Then again, take a screenshot of this as well. 43. Now, I want to show you the answer to 44B. Um, so you can see how it works. So this is the 80% taxable income limitation for NOLs that are carried forward to the future year. So this is, the way you would do it for the future year. So you pretty much have to do an estimated tax return. Figure out what would the taxable income be before applying the NOL. So this is, the net income for the future, salary, so forth, adjusted gross income, itemized deduction in this case, 35,400, and there is, there is deduction on qualified business income, which is, partially affected by, this loss over here, the $34,000 loss over here. So that's something to think about. Um, Again, $44,000 loss from the business loss here. That's a qualified business income. Um, so that's the $44,000. $60,000 was the income in the future, so it's percent of that. Um, well, not necessarily. You're supposed to do it the lesser of that, or 20% of modified taxable income. That's the step that they're missing. But I'm going to assume that they did it correctly. What I want to direct your attention is this particular rule. The 80% of taxable income. That's the limitation. So even though they have a good loss to use the $34,000 loss, can they use it? Do they have enough to offset it? Well, taxable income up to this point is 48,400, right? If we apply 80% of that, is 38,720. In this case, they'll be able to use the full amount, right? Because 34,000 is less than 80% of the future taxable income, they're going to be able to use the full amount. In this case, it would work either way, even with the new tax law. They'll be able to use the full amount. Never mind. I thought there would be a cap because of the 80% on this one. So it doesn't really change anything on if you're carrying it forward. You'll be able to use the full amount even under the new law. However, how would it change under the new law in terms of carryback? Under the new law, it doesn't change much in terms of how much you can utilize because it's still going to be $34,000. Again, you're limited to 80% of future taxable income, and you're covered either way. Under new tax law, you can still use 100% of taxable income. You're still using $34,000. But how does that change for NOL's carryback under the new law? You can carry it back for up to how many years? 5 years, right? So you can carry it back up to 5 years. So that's under the new law, under the CARES Act. So, any questions with this problem, this NOL problem? No questions? Okay, I tell you what. I'll do one. Again, we're not done with this chapter. Let's do. I want to do a tax depreciation problem. And this problem is actually good because of what we're going to cover next. So let's do a problem in chapter 8. You guys ready in chapter 8? You guys ready? Say yes. Say yes. Are you guys ready? I would like to hear.
Yes.
That's better. Thank you. I was
Yes.
gonna say, tax
Yeah,
law is fun. Yes, that's better. You're supposed to be excited about this. Am I the only one that gets excited about this stuff? So late at night, sometimes I wake up in a cold sweat thinking about tax laws. Tax law is going to change this. Okay, that's sort of true. I have no life. Um, I don't want you guys to end up like me. I want you guys to have, life other than accounting and tax world. But if you do end up being a nerd like myself, you'll be in good company, and there's nothing wrong with that. There's nothing wrong with thinking about tax law and tax law changing and what is Congress going to do and so forth. Remember, tax law affects everybody. It's very practical. I guess again for me, when I think of a situation, I pretty much think about how does it relate to taxes. Even like let's say I go to every now and then I go to right around December 30, 31st. I'm around downtown area filing paperwork, and I usually pass by the court office for where's the court? I know it's downstairs and at the city hall where they get married. Is that what department is that? Whatever it is. But every time I pass there, right around the 31st of December, why is there usually a line? Well, they're trying to get married before the year's over, which is fine. You know what the first thing that I think of in that situation? This is what I usually think of. Do these people know that their filing status is going to change because they got married this year instead of waiting a couple more days? Yeah, these are the thoughts that go through my mind, and I almost want to start a conversation with a couple of people, but I decide not to because I'll probably get beat up and or something. But yeah, these are the type of thoughts that run through my mind. When somebody wins a prize, somebody wins a Super Bowl. Do you know how much taxes they're gonna? Again, this is how my mind works. Again, I'm one of those weird people. This particular situation is a very very common situation. And then for 31, this is a good question because I like this question because it's not just touching your topic on depreciation. It's also touching topics on property transaction. So in this situation, Blue Company acquired an asset that's a residential property which has 27 and a half years for $200,000 and used it for business. She took out depreciation of 642. She claimed depreciation of 642 and 5,128 the first 2 years. Those amounts were incorrect. She applied the incorrect numbers. She used the non-residential rate for 39 years instead of residential 27 and a half years. She under depreciated. Either way, she under depreciated. She sold the asset for $180,000. We have to figure out the gain or loss. Again, this is a very good question because it's sort of going. It's a preview of what we're going to cover next. What we're going to cover next deals with property transactions. Give you a review on property transactions. There's three questions that you're going to be asked when we're covering property transactions. Let me show you this quick screen so you guys can see what I'm talking about in terms of the question. No, not this. All right. So again, these are the questions I want you to think about when we're dealing with property transactions. What is the gain or loss realized? Selling price minus adjusted basis, which you guys already know how to do. What is the gain or loss recognized? Generally speaking, yes, unless there's a provision that tells you otherwise. What that means is it reported on the tax return? Is it do we get a deduction for the loss, or if it's income, is it reported? So generally speaking, yes. And if we do report a gain, what is the character of that gain? Two characters: ordinary income, capital gain, long-term capital gain. Those are the two characters that we're thinking of. Right now, we're just mostly concerned of the first two questions. Now, how do we figure out the gain or loss? Difference between amount realized minus adjusted basis. Amount realized, that's your selling price. Your adjusted basis is your cost minus your accumulated depreciation. It gets a bit more detailed than that. Here's what we're going to walk through in a few minutes. But again, amount realized minus adjusted basis equals your realized gain or loss. Adjusted basis is your cost plus capital improvements minus capital recoveries. In other words, cost minus accumulated depreciation. Now let's go back to this question. Oh, and by the way, since we're still on this topic, in terms of character issue, again, quick overview on the character issue. Character is determined by the type of asset and the holding period. Remember, holding period long term is what you wanted the asset to be held at. There's three types of assets. There's ordinary income asset, which is your inventory and your receivables. You sell that, you're going to generate ordinary income, no special treatment, no special tax rate. Then you have fixed assets. Mostly it's fixed assets. Those are your 1231 items, Section 1231 items. Remember, capital asset is not defined in the Internal Revenue Code. Remember, the Internal Revenue Code does not tell you what a capital asset is. It tells you what a capital asset is not. So it tells you a capital asset is not inventory, receivable, or fixed assets. So you either have ordinary income, your inventory, receivables, fixed assets, or capital assets. That's the best that I can tell you right now. All right, so I know that's quite a bit of information, but again, let's see if we can apply these principles here. Going back to the problem. All right, first question. We have to figure out the cost, $200,000 minus accumulated depreciation, right? Now, the accumulated depreciation, we're going to take it up to the year that we sold it. In the year that we sold it, its mid-month convention is going to be the middle of that month plus the previous months. Now, the question that I have for you, are we going to use the depreciation that they claimed, 642, 5,128, or what they should have claimed, 910 and 7,272? What do you guys think? Anybody? What they claim or what they should have claimed? Take a stab at it. Anybody? Anybody want to take a stab at it?
What
Matt,
they
you're
should have
quiet.
claimed?
Who was that? Was that you, Matt?
That was Matt. Yeah. What they should have claimed?
Yes, very good. So it's going to be the 7,272 and the 910, and then whatever depreciation is for the year. So yes. So I'll tell you how to take care of the other issue. Let's take a look at the answer. So it is what they should have claimed. That is correct answers. So, well, I'm looking for the question. So what are considerations? So what should they do with the other 2 years for what they should have claimed? How can they recover that? What do you guys think?
They have to
Amended,
do an amended return.
amended return would be one way of doing it. Is there another option? Well, you actually have a change in accounting method there. So you do the 3115 and recompute the depreciation. That would be actually the quicker way of doing it because that would be included with the tax return of the current year. Instead of amending the return, it would be much better to do a change in accounting method, which is what you're doing. You're changing the accounting method, a bit more complicated, but it's actually worth it, and you'll get a bigger refund, or you could amend the return. Either way works. All right, so we have to figure out the adjusted basis. So cost minus accumulated depreciation for the first 2 years minus the accumulated depreciation for, they sold it in January, right? So they only get half a month for January. That's it. So 303 for the last year. So the basis was $191,000 and change. They sold it for $180,000. They have a net loss of 11,515. That's their net loss. Next question. What type of asset do we have? This is an asset. I'll give you a hint. This is an asset that has been depreciated. What type of asset do we have for tax purposes? Excuse me. What type of asset do we have for accounting purposes? It's a fixed asset, right? Fixed assets for tax purposes are what type of assets? 1231 assets, right? This is not a capital asset, not a capital asset. This is a 1231 asset. How do we treat this loss? I'll give you a hint. It is not a capital asset. So how do we treat this loss? I'll give you another hint. It's not a capital asset. It's not a capital loss. If you don't have a capital loss, what's the other type of character? If it's not capital, what is it? Ordinary.
Ordinary?
Yes. Remember, capital loss is the most you can deduct is $3,000. Ordinary, all of it is deductible. One of the things that I'm giving you a preview of property transaction, that it's more than just the default for whatever reason people think everything is capital. No, 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 not everything is capital. No, not everything is a capital loss. Not everything is a capital gain. That's no, it's much more detailed than this. There, we can have ordinary income. Can have ordinary gains, and everything is relative. This case, we have a fixed asset. We have an ordinary loss. The 11,515 is fully deductible, not subject to the capital loss rule. Suppose they sold it for more. Again, the basis is $191,000. Suppose they sold it for more. It gets more complicated then. It's still not a capital gain. If they sold it for more, you have a gain, but it's still not a capital gain because it's not a capital asset. That's the best that I can tell you for right now. It's not a capital loss because it's not a capital asset, and it's not a capital gain because it's not a capital asset. However, 1231s can have capital gain elements to it, which is something we're going to cover in more detail later. But that's like after we cross or pass a couple hurdles, then some of it may be capital, but not by default. It's not by default. Everybody thinks it's capital, but it's not. All right, so that's it with this question. Any question on this particular question in terms of figuring out the depreciation? Again, we're going to revisit chapter 8 and tie loose ends with 9 and 10, but I want to get started with property transactions and stuff. Property transactions. No, that's not it. So Baby Bear and Papa Bear. Yeah, I was getting bored and I was running out of names. Here it is. All right, let's go to the beginning of this lecture, property transaction. So this is what we're going to do today, sort of, or we're going to continue to do today. The capital gains netting procedure, I'm going to cover that in more detail next week. There is a spreadsheet that I want to go over. Again, that's covered in more detail next week. We did start covering the different types of assets. So let's review with this part. Now, what I have here, that's actually another handout. The different steps that I have. I've posted another handout that is a bit more inclusive in terms of it includes everything. It summarizes everything that I'm going to cover, and I'm going to use that as a basis and the way I'm going to lecture you right now. So this is an overview of property transactions. Give me a second. All right, let me switch. It's the same steps, but I want to show you this particular handout. Quick overview, and then we're going to walk step by step. Again, take a look at this handout. Again, this is the same steps that I'm going to walk you through right now. 3 different questions: what is the gain or loss realized? What is the gain or loss recognized? And what is the character of the recognized gain or loss? Again, good explanation of it. Remember, amount realized minus your adjusted basis equals your gain or loss realized. And this is, how they came up with the number. Now, is the gain or loss recognized? As a general rule, all gains, let me zoom in. All gains and losses are recognized. Can you see that where it says under section 1001? 1001C. All gain, and actually 61 also has that. Section 61A has it as well. All gain or losses are recognized, right? Except when you're not recognizing it. Per minute, self-personal residence. Section 121, we sort of talked about this before. There's an exclusion available on the portion of your gain, $250 for unmarried taxpayers, $500,000 for married individuals. As long as you meet as long as the residence is your personal residence for 2 out of the last 5 years. I'll get into more detail how that works next week. You'll be able to exclude up to $500,000 of your gain or $250,000 of gain. So that's an exclusion right there. Now, in terms of losses, and I kept saying this, losses on the sale of personal use assets are disallowed. Related party losses are also disallowed. Wash sale losses are disallowed, but that's not included here. And I'll tell you why in a few minutes. So these are always going to be excluded or not reported. Now, for the other part is it's temporarily reported. It's just not. It's not a matter of it's going to be taxable. It's just when. Like exchanges, involuntary conversion, installment sales. That's what we're going to cover in more detail next week. Now, here's what we cover in terms of the capital. Remember, it talks about the different types of assets. It's either capital, 1231, or ordinary. Again, this is how they're detailing it. And again, these are the capital. But just follow my ways in terms of explaining it. Everything is capital, right? Or everything that's not one or two is capital. All right. Again, take a look at that note, that handout. Same thing that I have in my lecture notes. I just presented slightly different. Go back to my lecture note. As soon as it stopped. I don't know why it's freezing. All right. Go back. Okay. Again, realized gain or loss. Again, realized gain or loss, that's the difference between the amount realized and adjusted basis. Again, from this point forward, if I say AR or if I write AR on on any of the notes or type it in any of the notes, I'm not talking about accounts receivable. I'm talking about amount realized. The amount realized, and then minus adjusted basis. Think of adjusted basis as your net book value for accounting purposes. Net book value is your cost minus accumulated depreciation. Now, in terms of amount realized, it's going to be cash plus the fair market value of property you received minus liability assumed by others. Again, that's a cancellation of indebtedness. Again, somebody else assuming the liability, that's considered income to you. If you're paying cash, that's a subtraction. If you're assuming the liability, that's a subtraction. Again, that's covered in more detail when we're covering like-kind exchanges, and that's in more detail next week. So think of about amount realized is your selling price, cash received, minus cash paid. So your selling price minus selling expenses is your amount realized. That's your consideration. Amount realized is your consideration, net consideration you're receiving. Adjusted basis is what you're giving up, the basis of what you're giving up. It start out with your initial basis, which is either your acquisition basis or whatever you start out with, your initial basis. You're going to add any capital improvements and you subtract capital recoveries. Now, again, this is covered an expansion of what I just told you right now. Recognized gains, that's a reportable gain or loss. Again, taxable gain or deductible loss. As a general rule, all realized gain and losses are recognized, except when they're not. It's sort of a joke in a way because that's always the way the code. That's the way the code is again. It's written in a way where everything is income except when it's not. And again, remember like section 262, where it tells you no deductions for personal expenses except when it is. So that's sort of how the code works. Just think of it that way. Everything is considered income except when it's not, which is sort of a good way of applying it. It's all income except when it's not considered income. So first situation, which losses are not recognized? There's only a couple. Sell personal use asset. I said that several times. That's never allowed. Related party losses. You sell something to a related party. Disallowed to you. Wash sales, sort of disallowed. It's sort of an application of the basis, but it is disallowed. So what are the gains that are not recognized? I talked about that briefly. Sale of personal residence, Section 121 exclusion up to 250 or 200 or 500,000 if for married individuals. Temporary exclusions, meaning that is not going to be income. It's just a matter of time. Like-kind exchanges, also called deferred exchanges, they're still pretty popular. You're exchanging one property for another property. This is not you sell your property and buy another property. That is not an exchange. You exchange one property for another property. That's a like-kind exchange. Involuntary conversion works a little bit differently. That is, you're receiving proceeds because they condemned your property or it's destroyed, now you got to reinvest it. There may be some gain or loss issue. Or installment sales, we'll cover that in more detail later. Now, in terms of the character of the gains, it all depends on the type of asset and the holding period. Remember, there's three types of assets: ordinary income assets, inventory and receivables; fixed assets, which are your 1231 assets; or capital assets, which is not one or two. Remember, holding period: short term, 1 year or less; long term, more than a year. And a lot of that we already went over. Now, what we're going to start covering from this point forward is a bit of an advance. Well, not too advanced. It's the preliminary of basis. Now, when it comes to basis, you can never start with it. Well, I shouldn't say never. Generally speaking, you receive something, even if it's as a gift, even if you don't pay something for it, you have a basis. There is a starting point. You have an acquisition basis, you receive something as a gift, or you inherited something. You have a starting point. Even though you didn't pay for it, you have a starting point. The starting point, that's your basis. That's where we start. So the first thing is your acquisition basis. Pretty straightforward. That's your cost plus any amount, any expenditure that you incurred or paid that gets the asset ready for its intended purpose. Same thing for accounting purposes. Same rule for accounting purposes. Any cost that gets the asset ready for its intended purpose gets capitalized and then depreciated. Same thing works here. Gift basis and inherited basis, that's a bit different because it's a bit more complicated. Gift basis, that's usually the donor's basis. And inherited property, that's the fair market value at date of death. Again, those are the general rules. Let's talk about the gift basis. Again, as a general,
I actually had a question about the fair market value at date of death.
we're not there
How
yet.
is it?
Hold that
Okay.
question. I mean, come on, can't you wait for when I cover that? I mean, it's right here. It's next. Just wait, because chances are I'm probably already going to answer before you even ask. So just think about that. And we're going to cover it. So hold that question until I go over the problem. Okay. All right. So in this example, general rule, the basis is the carryover basis plus the gift taxes paid. But right now it's just a carryover basis by the donor. Again, it's going to be the donor's basis, except when it's not. So when the fair market value is less than the donor's basis, the fair market value of date of gift, then it all depends on what the donee does, the subsequent sale. It doesn't matter the person making the gift; it's whatever the donee does. So it all depends what she does after the fact. If the subsequent sale is a loss, use the fair market value. If the subsequent sale is the gain, use the donor's basis. If the subsequent sale is between the fair market value or the donor's basis, use whatever the selling price, meaning there's no gain or loss recognized. Again, these rules also apply with related party losses. Holding period starts when the property is received by the donee. Let me go over the property transaction problem. Okay. In order. So gift property transactions. This is an example where the fair market value is less. So over here we have fair market value is less than the I'm gonna adjusted basis, right? Right? So we have fair market value 15K, 20,000. All right, under the first set of facts. Letter A, they sold it at a loss. So what do the rule go? If they sell it at a loss, use the fair market value, right? So for letter A, I'm going to go here. If they sold it at a loss, I don't really want it to, well, I do want it to go here, but it's going to do that. I hate when it does that auto formatting. I don't want that. All right, so I'm going to go here. So amount realized is 12,000. Actually, amount realized minus adjusted basis of, let me add one more space. adjusted basis of 15,000, right? What do we have as a gain or loss? I don't have a calculator with me. Well, I do have a calculator. What's the answer here? Why is it doing this? All right, what do you guys have here? Well, I'm not going to put the underline. It's starting to act up again. Oh my. Yeah, it's starting to act up again. Sorry about that. What do we have as a loss? I'm just going to put it as a negative number because it's acting weird. What do we have as a loss? Come on, people. What's the loss here? 12. Thank you. $3,000. Okay, $3,000. Everybody okay with that? Okay, so we have letter B. Again, if they sold it, this should be letter B, but it's acting up again. Letter B. So pretend I type letter B here. So letter B. If they sold it at a gain, use the adjusted basis, right? So amount realized, AR. You know what I'm gonna do? I'm just gonna copy and paste this. Why is it acting up like that? All right. You know what I want to do? I want to put this in Excel. I'm going to put this in Excel instead. This is acting up too. Give me a second. All right, so we're going to use. I'm just going to type the answer. It's going to be 22,000 minus 20,000. Kidding me. Well, you guys get the gist of it. So what do we have here? Minus 2,000, minus 20,000. I'm just gonna type it minus. Oh, it's not letting me. I'm just put a whatever. Minus 20,000. What does that equal? What does that equal, class?
2,000.
2,000.
Thank you. Okay, and then letter D. Or letter C. If they sell it between these numbers and it's a selling price, amount realized 17,500. Adjusted basis is 17,500. Right? Any questions with this one? With this one only. Okay, let's move on to the inherited property. All right, on the
Wait, can you actually go over C? What would be the realized loss or gain?
Nothing.
It would just be nothing because it's between the fair market value and the.
Yeah, exactly. A subsequent sale is between, and it doesn't mean in this case it's exactly in the middle, but it doesn't mean if it's between those two numbers. If it's $18,000, or 12, whatever, it's between those two numbers. Use the selling price, which results no gain or loss.
Got it.
So that's what happened. No realized gain or loss. So good question. All right, next question, and it is actually pretty basic here for the inherited property basis. So for this, the general rule, the basis to the recipient is the fair market value at date of death. This is known as the step-up basis. The exception to that would be if they use the alternate valuation date, and then the basis is going to be the fair market value 6 months or after the date of death. Or if it's distributed earlier, it's going to be 6 months before, or it's going to be the fair market value when it's distributed. So again, a fair market value at date of death, or if they use the alternate valuation method, it's going to be 6 months after. Or if they use the alternate valuation method and they distribute the property before the 6 months, then it's going to be the fair market value at date of death. You guys get all that? Fair market value, date of death. They use if they elect to use the alternate valuation method 6 months after, except when they distribute it beforehand. Guess what? I have a problem with those fact patterns. Let's take a look at tax deduction problems. The next one. Well, not tax deduction problem, property transaction problem. Where is it? And you gotta bear with me on this one since it's acting funny. Well, it's actually pretty simple. Actually, with this one, I can just type up the numbers. Okay, Abe S. died in January 2018. They conveyed the stock to Abe's grandson. It's valued $200,000. In June, it's valued at 175,000. This one's actually pretty simple. What is the basis of the stock to Bart? What do you guys think? Letter A. I just gave you the answer a few seconds ago. Thank you. Okay, letter B. Letter B, they use the alternate valuation date. What is it? Anybody? Right? 175,000? Right? Letter C. They use the alternate valuation date, but it was distributed beforehand. Oh, actually, no, this one's actually a bit different. Well, yeah, no, it's assumed that Bart received the stock in May. It was distributed beforehand when it was worth 180,000, 180,000. That's it. Now you can ask your question if you still have a question.
It was about how long you have afterwards to determine. So alternate market value explains my question.
6 months. You have up to 6 months to alternate value or the date that they distributed the
No,
property.
that just answered it because I was going to ask what like property, like land, things can often take up to a year to sort out, and so the 6 months afterwards explains when you can choose what place. Because I was thinking like, what if there's a collapse in the real estate market or a boom or something? When would you value it? And so that answered my question. Is you have the choice between the date of death or the alt AMV.
But that election has to be made at not the person receiving it. That election has to be made at the estate level. When you're filing the estate tax return, that election is not made at the individual level.
Okay.
It's made at the entity level. The whole purpose of that is the goal is to save money on estate taxes. Then yeah, you would, and it would work in this case because think about this: it's 200. Let's actually just change the facts. And let's say this was real estate. Doesn't matter what type of property, but let's just say this is real estate. Same fact pattern. It was valued at the beginning of the year $200,000. 6 months after is worth less. Well, for the estate, it would make sense for them to value it 6 months after because it's worth less. They're saving money on estate taxes. If they're going to use that, then the recipient has to use that as well. It flows. The recipient does not make that election by himself or herself. That election is made at the estate level. And that's usually why it's made because it's going to be valued less 6 months after. So yeah, that's the basis rules. Any other questions regarding basis, fair market value, date of death, all that stuff? No? No questions? Okay, there's a couple more items here in this property transactions. So inherited property, talked about basis. So in terms of disallowed losses, how many times do I have to say this, class? Sale of personal use assets are never deductible, ever, 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 ever. Section 262. Related party losses do happen. That's also non-deductible. Wash sales. The way wash sales work is let me give you it's a 30-day window before or after. You can buy the same stock within that window and try to benefit from deducting the loss. I'll give you an example of some type of tax planning tips that people try to give. It doesn't work because of this particular rule or this particular law. So let's say I have ABC stock. I'm actually generating a loss. I'm going to lose a lot of money. So somebody told me I can sell it December 31st, ABC stock, sell it December 31st, claim the loss that year, and then buy it back within a couple of days. Can I still claim the loss? No. That's considered a wash sale. Anybody that gives that type of tax planning, they're misled because they don't understand how wash sales work. They won't. I won't be able to deduct the loss of the initial sale. So that's considered a wash sale because within that 30-day window of the identical, stock, it won't be allowed. Again, something that I'll cover in more detail a little bit later. Capital losses. Remember, the code doesn't tell you what a capital asset is. It tells you what a capital asset is not. A capital asset is not inventory, accounts receivable, depreciable assets, non-depreciable asset, and certain copyrights or artistic compositions. That's what a capital asset is. Now, actually, we do have time to go over the netting procedure. And I think this is where we're going to end with the netting procedure. This is a lot of fun stuff. Are you guys having fun yet? Yay. Come on, class. Are you guys having fun? Thank
Yep.
you.
Yes, yes.
Thank you. Thank you. I don't believe it, but thank you. All right, so I have two versions of the netting procedures. They both refer to section 1220. Oh, hold on. Sorry about this. It's taking a while to upload. Yeah, there's two set of notes. There's a spreadsheet there it is. There's a spreadsheet that I have uploaded. This is the spreadsheet, and then they have just the basic one that has just on this level. Again, looks sort of like a bracket. If you're playing March Madness, this is sort of what it looks like, right? But it's pretty straightforward. You gotta group them in terms of short-term to short-term, long-term to long-term. Short-term gains to long-term losses, long-term gains to long-term losses. Then whatever you have a net short-term gain or a net short-term loss. You offset it with your net short-term gain or net long-term gain or loss. So whatever you have on top, you offset it against the bottom. Pretty straightforward. And it all depends on what happens next. What is this end result? So what happens if both are gains or both are losses? So let's say you have a $2,000 gain here and a $3,000 gain here, both gains. So short term, so the 2,000, it's based on this, short term equals ordinary tax rate. So $2,000, that's treated as ordinary income. It's not taxed at a lower rate. Okay. What I have here, 3,000, my net long-term gain, that's taxed at capital gain rate. And capital gain rates, it depends on my whatever my regular rate is. If I'm at the lowest tax bracket, take a look over here, 10 and 12. You guys see that? 10 and 12 on the left-hand side? That's 0%. If you're at the middle tax bracket, 15%. Highest tax bracket, 20%. By the way, the 20%, that's, I'll give you a quick history. Bush, oh, I was going to put Bush. I can't type because it's acting up. So think of this as Bush era, 0%. Clinton era, 15%, Obama era, 20%. So that's sort of how it works. 20% still exists. That's the Obama era tax rate. Okay, so what happens if they're both losses? So negative $2,000. So we have a minus 2,000. Why is it doing that? Well, anyways, let's just say that's minus 2,000 and 3,000. How much? In terms of capital losses? What's the most you can deduct in terms of capital losses? The answer is right there, right? The most you can deduct is $3,000. Excess is carried forward. So you do have to keep track of how much is short term, how much is long term. But yeah, the most you can deduct is $3,000, not five. $3,000 is the most you can deduct. All right. So what happens if one is a gain and one is a loss? So if there's a net gain and one is a net loss. So what happens if the net long-term gain is more than the short-term loss? So we have a net long-term gain. So we have a $3,000 here. And actually, let's leave those two numbers here. So you have a $3,000 net long-term gain, but you have a net short-term loss of $2,000. So what happens here? If net gain is more than a short-term loss, the net gain is treated as a long-term gain. So you got a net to 2 here. 3,000 minus 2,000, you have a net capital gain long-term of $1,000. That's taxed at long-term capital rates. Then you net to 2. 3,000 minus 2,000, $1,000 will be taxed at a lower rate. But let's say the opposite is true. Let's say $3,000 is up here as a short-term gain, and then you have negative 2,000 here. What happens here? Well, net capital gain is treated as a short-term capital gain. So it still nets itself to $1,000, but it's short-term, ordinary income. Think of it this way: if there's more long-term, then it's capital. If there's more short-term, then it's ordinary income. That's what all this means. And again, we'll walk through this example in more detail next session. This is one of the handouts, but this is section 1222 in a nutshell. And remember the netting procedures. But what if I told you it gets more complicated than this? Yes, it gets more complicated than this, believe it or not. I don't believe it can get more complicated, but it can. Any questions on this stuff? Any questions on property transactions? Do you guys feel comfortable on what we've covered so far?
Second that.
What's that? No questions? Yeah, do the homework assignments, including what else, class? What else are you going to do in addition to the problems in your book? What else?
Read your article.
Oh, well, yeah, that's true. But
Watch your YouTube videos.
no, I'm talking about what. Yeah, that too. But
Tax return.
the property transaction problems. Yeah, don't forget to do the property transaction problems. Again, we got a couple more we're gonna do. We got a like kind exchange problem we're gonna do next week. Yeah, this is the one we're gonna do next week, and involuntary conversion. Take a look at that next week. Installment sale of fixed assets. It gets interesting from this point forward. Remember, the final is going to be cumulative. So it's going to contain everything. Yeah, I think this is a good stopping point for today's session. If you guys have any questions, you guys want me to go over anything else? Again, we're not done with chapters 8, 9, and 10. But I did want to get into property transactions. We'll do a couple more problems from 8, 9, and 10. Again, a couple more problems, basic problems from depreciation, and then in terms of 9, not so much actually, because we talked about business deductions. 10 is just more identifying itemized deductions. There's only a couple questions that I want you to go over there. We'll touch on those. And 11, don't really go over the 11 question, because that's in terms of passive activities, I covered what I want you to know. Focus more on property transactions, going forward for the next stuff. I guess over the weekend, focus more on property transactions. Still pay attention to what we covered in passive activity, itemized deductions, and so forth. Of course, go over self-employment tax, net operating losses. That's covered on the exam. Again, I'll go over that self-employment tax problem one more time so you guys can see how it works. And again, you guys have to practice it on your own as well, so you can put it together. So that's going to be on the final, that big problem. Okay. Any questions? We're actually ending early today. Anybody want to make a motion to adjourn?
Motion to adjourn.
Motion to adjourn. I second the motion.
All right, thank you guys. We're leaving early today, but you guys are going to use this time to study, I'm sure, right?
Yes, thank you.
All right, I'll see you guys next week. Study over the.
Bye.
Have a great weekend.
Thank you. Bye.
Thank you.